on those, and,
But one example is
we want,
the
Yeah, go ahead.
the Janice Henderson,
Yeah.
bond fund that's one fund. We certainly want to look at that. It's on watch. We're not prepared at this meeting to recommend that we change that fund, but most likely by next meeting, you'll see us recommend that fund be eliminated pending our investment policy review and our committees, and our chief, our investment committees. But then also there's a fund, the JP Morgan Strategic Income Fund, that should be added to this for at least two different bond funds. And so we don't have that recommendation today, but that is being worked on. And if the desire is that we present that immediately, then we can certainly be back to you very quickly. But our thought process is more to get you used to the reporting systems we use, put your current fund lineup through our process, see where there's a problem with any of the current ones, and then over time start to add in where we think that there's some missing opportunity.
And
or
I would
better
say,
fund.
not to disagree, but I think we also have to keep in mind this is an employee benefit plan. We're not looking at our own individual investments, and there is some value to stability, and employees have a sense of comfort or calm or whatever you want to call it. Psychologically, I think it does throw people for a loop if you suddenly totally switch out everything. It's like, well, was there something wrong with the other ones or whatever? And I'm not saying we shouldn't make changes when we should, because we obviously should. That's why we're here. But I think a deliberate approach and doing it.
There's three funds on watch. We're kind of getting ahead of ourselves here, but there are three funds on watch. One of which is the Janice Henderson, which is really a manager change issue, the bond fund, and then the JP Morgan MidCap. Well, that JP Morgan MidCap, that's who we also use in almost all of our other plans. So even though it's on watch, we wouldn't be recommending a replacement for that manager. The other is the JP Morgan Small Cap, and right now we've compared that against Adirondack, who's another manager that we use, and it's a horse race right now, and so we don't, as it sits today, we wouldn't recommend major changes. That the three managers that are on watch are being looked at, one of which will stay in the fund. And Janice Henderson's kind of more of an issue of whether we're going to add in Metropolitan West or not.
Yeah, and I'm not trying to get into each fund. I just think, I know when these funds were selected, part of the criteria, I think, was the revenue share, whether it was there, whether it was an option, whether it wasn't.
yeah. So,
I'm saying that if you were designing your recommended best plan of alternative investment options today, with a no revenue or any revenue that is included would be rebated back to the owner of that account, then what would be your recommended funds? And those are the ones I want to be involved with, because stability is important, but not at the expense of performance.
well, and I think there's two probably important elements there. One is part of our evaluation process does look at their expense, their revenue share, and their share classes available. So that's already part of the process when we look at or vet any funds. The second part of that is it will depend a little bit. If you guys were to move to a fee leveling, all of a sudden you may now have funds that aren't available, or because there's not revenue share available, that makes your choice a little bit different. So I think, if that makes sense, the revenue share can change the picture pretty dramatically, and how you want to handle the revenue share. So that's what we took as the assignment from this. Was our last meeting was to look at your current lineup, look at what your revenue shares of those current funds, and what would happen if we were to move to a zero revenue share. And that's kind of what this report shows.
And when you, sorry, I was just gonna say, when you say zero revenue share, there's still enough to pay Prudential's fees?
None. No, those fees then become explicit. Your participants begin to see a Prudential fee, record-keeping fee on their statement, and it's an explicit fee.
So you're gonna deduct that from participant accounts?
That's if you want to move to that model.
And the same with your fees?
Yeah, our fee's always been explicit. So we don't get paid from revenue share.
But they've been paid out of the plan assets generally, not out of individual
It
accounts?
depends on how you guys want to do that. Our fee can be paid out of the plan assets. If anytime our fee's paid out of the plan assets, it's an explicit, they'll see an advisor fee, and they'll see and know exactly what it is. So,
Well, I mean, in the past, that's what we've used the revenue
Yeah.
shares for, is to pay
Yeah.
those kind of fees.
So you
I'm
can, the excess flows into an account. You can use it for that purpose.
Right. And that's-
Absolutely, yep.
So what we're talking about now is not generating any of those fees, but instead charging participant accounts
Right.
a fee.
Yep.
Just so I understand too, can I go back to this analysis?
Uh-huh.
Just so I understand, so the net expense ratio, particularly on the two that you pointed out that are in red, it appears that the net expense ratio would be lower for the participant overall. A drop, for example, from 0.63 to 0.49 under the T. Rowe Price 2020, is that correct?
Well, but you've got to take in the account of the revenue share, because that 0.63, that
Yeah.
0.15 is what your participant is paying.
Right, they would be
and
paying
which
the
goes back, and then they're
0.63.
getting some of that back.
But that's the problem, is they don't understand
They
or
don't.
can't see always that portion that's coming back, and that's why we wanna be more transparent, but just so I understand, we would be actually moving from 0.63 to 0.49. Now, there would be other charges, but it'd be transparent, like you said, there would be a charge for the administrator, your charge, and it'd all be spelled out.
Well, yes, other than, I think maybe the one nuance there is that 0.63 with the revenue share that you capture, the net expense to your actual participant is
Uh-huh.
only 0.48. So you have to look at that and say, what the participant is actually paying is 0.48. But if we move to the zero revenue share, then the participant's gonna pay 0.49. So their cost actually goes up a little bit,
Yeah, you're saying it's 0.48 because the 0.15 comes back.
yes. It's
So
not
the
part of.
question is transparency, if we keep these same funds, is transparency worth that extra point?
I think it,
My point is, if it's 1 basis point, I think I would prefer transparency.
Yeah.
But if you have a fund where it's,
look at the
little
Invesco
more.
Growth Fund.
and I don't have a problem, if the better fund is one that does have revenue sharing as compared to one that doesn't,
Yep,
then if that revenue that's generated can be credited back to
Yes.
the account that created it, then
Ex-
the employee
To
is
the
better off.
exact employee that created it.
Right.
yes.
Then
Right.
you got
Not
the
to the fund
transparency.
in
Not,
general.
not to the whole general population.
Correct, so that it goes directly to the one that generated the fund. For instance, the guaranteed income fund, we have 20 basis point there to help fund overall fund expenses.
Mhm.
But if it were a no revenue sharing, that would then drop
Yeah.
to zero
Yep.
because, but if this other one is, if it's better, to have one that does have revenue sharing and it's enough to justify the difference, such as the Invesco Growth and Income, one's 0.29,
Versus 0.39,
0.39.
yeah.
Then if it goes right back to the individual plan participant that has that fund, then that's fair, that's
Yep.
justifiable.
Yep.
You can show, look, yes, we have this one that has revenue sharing, and that revenue goes right back to you.
So, I mean, this is you guys are not indifferent. This is the big debate that's going on right now. Do you just go to a no revenue share? Do you use a revenue share? What we would say as a fiduciary is you just need to define it. This is how we're gonna do it, and then follow it. I think when you look at zero revenue share and say, hey, is that probably the cleanest way to do it? Our answer would be, yeah. It probably is the cleanest way to do that. However, we have plans where our ability to go in and negotiate on the revenue share and the pricing, it's a benefit to them. So it's kind of a plan by plan basis, a little bit because of that dynamic. And we're fine to do either. In the fee policy statement, again, I think for purposes of discussion, and then as the committee decides, hey, this is how we want to do it, then we just write in the fee policy statement, this is how Utah County handles the revenue share. We just use funds that don't use any of it. And then there's an explicit fee for everything, and the participants know exactly what it is. And
So,
It's completely transparent,
Yep.
and I see a lot of litigation, and it's over fees.
Yep.
You had these fees, or you selected this fund
Yep.
because it generated these fees.
Yeah.
When it wasn't the best fund to have picked.
Yeah, and there's no question that the large, vast majority of litigation and lawsuits are around this very issue. And it's really because the plan sponsor has never they've never dove in and really understood what the revenue share is, and then you have participants going, I was paying 35 basis points to Fidelity or Prudential or whoever, and this isn't nothing against those providers, that's just how that's kind of how it's structured.
but
So,
keep going then with that, if then there's a charge to participant statements for the cost of administering the
Yep.
plan, and how is that determined?
So, for example, so again, there's different ways in which you can do it. You can say, look, we're gonna, for example, right now Prudential and Kelly, if I misstate this, please correct me, but Prudential's fee is 0.12. Right, so if they collect,
Prudential's fee is 0.07,
okay,
and
but
then
there's a five,
the Dick's fee is 0.05.
okay. So,
0.12.
yeah, so in other words, between Prudential and Dick, there's 12 basis points.
Right.
And if Prudential collects 15, they take 12 of it and they pay themselves and they pay Dick. And then the
Okay.
3 basis points they put into an account. And then you can choose on how you want that. You can rebate it back to, again, as you just mentioned, you can say, look, this goes right back to the participants that paid it, so it's gonna go back right back to those accounts. You can use that and say, hey, we're gonna use that money to pay other fees that the plan may have, like audit or advisor or consultant fees. Or you can say, just rebate it back pro rata to everybody. And so, so you have the flexibility to do that. And you can change that each year. It's basically in that type of account, once a year, you can say, this is what we're gonna do with that money this year. So you have flexibility on how you wanna have that money flow and go back. But yes, it's there. And again, the important part is if you wanna use revenue share, you just wanna make sure you've got a good sound process to monitor and look at it. And that's what we're doing here, is we're looking at all of them saying, okay, what impact does it have? Does it really help your participants or does it not? And then at the same time, what's really kind of the clean and best way to do it?
Okay, I'm not sure.
It gets complicated,
Yeah,
right? Because
it
you look
Well,
at, you,
I
well,
mean, that's what we're doing now, but my question is, if we're going to zero revenue share, if that's the decision, then we are putting a per participant cost
Correct.
deducting from a participant statement. Is that, I mean, many participants are in all 3 plans in several different funds. Is it gonna be, is it like a blanket charge, or is it up
So
to us to figure out, or is it?
You have a couple of ways to do it. You can say, look, we're gonna have that fee, let's just say it's that 0.12. You can say, hey, we're gonna charge that, and those that have bigger account, you can charge it across the plan based on their account balances. So somebody that has a larger account balance pays more of that fee, right? Because they'll say, hey, if I have 200,000 in my
Not
in
if
my
they're in the
account.
guaranteed income fund, or of one that doesn't generate it, but I mean,
Well,
that's
so
what
you
I
can,
just-
you can level that, and say,
Yeah.
look, everybody's gonna pay, if we want everybody to pay part of the record keeping, and do that, you can put that in your fee policy statement and work with Prudential and say, everybody's gonna pay 0.12,
Or,
regardless of what the revenue share is of the funds they're using.
or have a per account
Yep,
cost.
or you can say,
Just a
everybody's gonna
quarterly
pay
accounts
$75,
cost.
regardless of whether their
except
accounts.
for 401K,
Yep.
separate. All right, well, we're not deciding that today, right?
Well,
Or
I
are-
mean, that was the instruction that we've had before.
Yeah.
For them to move forward with that basis. We made that decision a year ago. You weren't here, but that was the decision to do that.
I guess I can't do anything about it now, but,
So we wanted to just be able to have you have an idea of, moving to fee leveling. And again, if you ask us as a consultant, we think fee leveling is probably the cleanest way to do it. I think if you look at the overall expense to your participants, it is gonna go up a little bit. You have, of your 20 funds in the plan, there's you'll see 11 of these that they'd end up paying a little bit more than they are today. But I think it's a pretty small cost. So I think, again, it's really just it comes down to, as you as a committee, how do you wanna do it? What's your preferred way to do it?
fee level and zero rev,
Yeah.
whatever we call that, they're the same thing.
Yep, yep. You just go to zero on that. Basically, fee leveling is kinda saying, everybody's gonna pay into the plan for the fees. Cause right now, if you have participants that just choose index funds, they're not helping any of you guys that are in other funds that pay for the record keeping for your plan. 'Cause
And
they-
that, frankly, that's the basis for potential litigation.
Yes.
I'm paying for this, I'm getting no benefit. Whereas if you look at what the real costs, each account incurs that cost.
Yep. So again, I think for the committee, we can help draft a fee policy statement. We have clients that do all of it. The important thing is really there's 3, there's kind of 3 different ways in which you can handle it. We're talking about all 3 of those right now. That if you do it correctly, you mitigate your liability significantly. And again, we're on the plan and we're willing to do it. The important part is you say, this is how we do it. We are gonna use revenue share, or we're not, and then you follow it and you document it. So,
Would you need any more instruction on that issue now? I mean, I think you know.
I mean,
We've already,
I guess
mean,
I
we
would
had those
ask-
discussions last summer before you were on board.
I guess I would ask the question is, if we go to, no rev share, that's fine. But how do we want to charge the participants? I don't know, that's been decided. Do you want to do charge everyone a .12? Do you want
Per
to charge them
account
per
size.
account, per capita, per rata?
We were talking about it before, it was a per account quarterly charge.
yeah, but do you
And the
wanna,
one thing we have to, Tyler, the one thing I just always want to just have everybody keep in mind is there are 3 plans inside of one plan. So each plan that they participate in would have its own fee. So generally what we see on best practice from a record keeping standpoint is an asset-based fee versus a flat fee when you have multiple plans that people can be in. Some will have a higher balance and some will have a lower. And a lot of times the fee will eat up those lower, especially the ones like the 401A that's frozen. That a fee could potentially eat it up. So, my discussion point is just generally speaking from a record keeping standpoint, the asset-based participant fee works better than a flat fee.
Well, and I did disagree with that approach, because I think when you look at how you justify the fee at a later date, you justify it by where the expense is, and the expense is a per account fee. I mean, that's where the expense is, so that's where the payment should come from. I mean, if one account has, all of their funds and it's a large balance and it's all in guaranteed income fund, currently they're paying 20 basis points for that fund. And you can't justify that, in my view, if you're challenged later on, because where's the expense? Well, the expense for that fund is the same as any other fund. In fact, you could argue that it might be less. And so I think a per account fee is the easiest to justify if challenged at a later date.
Is there a way to break it into a fixed versus variable cost and approach it that way as well? Because there is certain fixed cost to any account that would be required, and then there's also that variable fee portion that might be able to be built in, I don't know.
we haven't,
Isn't the variable fee already in each fund? When you're in a fund, there's
Yeah.
an expense associated with the fund, and that would vary according to what fund you.
Yeah, a large cap,
So your account charge would include that variable fee, it wouldn't
No,
just
that
be
that
averaged
variable
out
fee-
into.
The variable part, that depending on which fund you're in, whatever the fund expenses are, that's still there, and when you pick a fund, you're picking whatever expenses in that fund. But I'm
Okay.
talking about the other expenses, the administrative expenses.
yeah, the Vanguard 500 fund is gonna have a less of an expense ratio than an international
So this per
fund.
account fee we're already talking about is just identify the fixed cost and do that per
Credentials
account, and then
fee.
the variable
Right.
portion will go
It will
depending on
It will
the.
still be there.
Okay, the other question I have, is there a way if someone has a small 401A that they could transfer that over into one of the other funds? It won't help the smaller person that's always gonna have a low amount, but is there any ability if somebody has a low amount in a 401A to transfer it over?
We've talked about this before, and my understanding is a 401A and a 401K or 457, they're different types of plans, and you'd really have to, I think, terminate the 401A plan to actually, and get all the assets distributed. You
And they
can't just
distribute
collapse it
the
into another
assets
one.
from one fund to the next,
You
so
can
there's
roll
no
or merge.
tax.
Not necessarily, because it's a
Ramification.
different kind of plan. I don't know, Kelly, I think, we've talked about this before, and I can't remember all the, steps that would be involved, but as I understand it, it would be, you can't just move assets from
Yeah,
a
you
four
can't
oh one A to a 401K. You'd have to terminate the plan, find all the participants, give them the option to take a distribution, right? And, so it,
Right.
in
Yeah.
our prior discussions,
You-
we decided we'll just have to let it sort of die a natural death because it really isn't, there isn't really a way to do it.
Well, can you do a merger? Can you help us do a merger? Is that something?
If
you've
you
done
want,
before?
if you wanted to terminate the plan, as you mentioned, then you've got,
Because I've heard of others that have
Yeah.
merged them together.
so you can and again, Kelly, you can weigh in here too, but if you terminate, you've got to give them the option of the one they can roll into the plan, as long as your plan allows it, which you of course could make sure the amendment's done to do that. But two, if
Right,
they,
but you can't,
if they
you
want
can't
to take
force,
it,
if you terminate the plan, you can't just merge the two plans
Yeah.
together. It's all on an
course.
individual basis.
they have the option to like take it as an IRA distribution or just take a flat out distribution, and you may have
lose a
assets.
lot of
Right,
assets.
and I don't
That
think
was
it's
another reason we
eligible for a
decided
merger.
maybe not to do it, or even.
I'll double check that for you, Lena, but I don't believe it's eligible to merge the two plans.
Yeah.
Yeah, I think I know we looked at it at least once before and determined it
Right.
wasn't really feasible, but maybe if there's another way to do it.
So that's the typical process to do it. And yeah, I mean, we can help in facilitating. We have a plan that we're doing that with right now that
Well,
we
Mel,
do, but
maybe
you do
Kelly
have,
could look at that again too and see if that, because
Yeah.
if we have a fund, you know, I don't see it dying a death because it's,
well, the other thing to think of here is, as Kelly mentioned, these plans get charged separately. So there's, your 401K plan is obviously the largest. Your other plans are smaller, so let's just say that 12 basis point stays in place, right? The 12 basis points on the smaller plans is a smaller dollar amount, so the per account fee is going to be smaller on those smaller plans than they are on the 401K. In other words, you look at each plan, and let me just say it this way, you look at the 401K plan and you say, hey, 12 basis points, you know, Prudential needs $100,000 as their fee. You just go and say, how many accounts do we have in the 401K? And you divide that amount by, if it's 2,500 people, you divide it by 100,000, and you say that's what every person per account, they just pay that fee. And that's the fee. And then you do that on the other plans as well. So that 12 basis points on your 401A plan is not 100,000, it's more like 35. So the per account, you know what I mean? You're not gonna have the same size of fee on a 401K, 401A, and your 457.
So if we were to move to a different way to charge the fees, is it proper then to notify all of the end users to say, hey, this is what your potential fee is? If you have small assets in your account, give them the option to close it at that point in time? Is that doable?
Can't take distributions,
Yeah,
except
I mean-
if they're qualified to do that.
Not unless they're terminated or,
Yeah, you can't just take an in-service.
Yeah, but I mean, at the same time, they're.
But that could be where a lot of them are, is with retired folks that are just having them there, and if they knew the fee structure and how it would affect them, they may make a
Well,
different decision.
the other part is, I mean, they're paying those fees today. Most are.
it's not an increased
But
fee. You could, you
yeah.
want to
They-
explain to
they
them,
don't
this is
see
what you've
it,
been paying.
but they're
don't
paying
see
it.
Say
or
they are,
understand
but they
it,
don't know
yeah.
that they are,
So
and
they-
so there's still gonna be the issue
Yeah.
of,
well,
they're
and,
gonna feel like I'm being charged something I didn't used to have to pay.
and,
Yeah.
and
But
some
even
of the
though I don't.
smaller participants
Right.
probably are getting a pretty good deal, because it's your,
If they're
right
not
now,
paying their fee, if they're not paying what the cost they're incurring,
they may be,
that's wrong.
you know, their portion that they're generating in revenue share might be quite a bit lower, because right now, you know, you get a few large participants, several large participants, and their fee is generating more of the revenue share. That's your problem.
But,
Yeah.
and that's, again, part of the argument for the asset-based fee, is you can say, look, we're gonna do an asset-based, it's not, we're not gonna look at revenue share at all, it's just gonna be, everybody's gonna pay 12 basis points. So those that have a larger account pay more of the fee, those that have a smaller account pay less of the fee. And so that's,
Again, that's less defensible though.
well, what I would say is, when you look at
Probably more.
the options from the DOL on how to handle revenue share and allocate it, that's
Yeah,
one of the
I know-
viable
I
ways
know
that they
it's
tell
one
you
of
you can
those,
do it.
And it's the more prevalent way to do it, would you
That's how
say?
most plans, we see a lot
I-
more asset-based than we
I
do.
think the trend is the other way though, from what I've seen.
You're seeing
The
more,
trend is to
more
complete
flat.
transparency, justifiable, and how do you justify it with
So-
a per account cost?
So you have arguments on both sides. Again, like, we don't have a dog in the hunt. I mean, we don't get paid that way anyway, so. We're just look at, I think, again, for the committee, it's what's your preference? And let's make sure we put a fee policy statement in place that says this is how we handle it. And then we'll ensure we work with Prudential to make sure it's done that way.
The one thing I see, you know, kind of worried about is a new participant, smaller dollar size, and they're getting, you know, a $25, $50 fee. That can be a deterrent to them at times to get into the plan. But
And maybe you have a waiver for the first year. I mean, you know.
Yeah.
I'm not telling you, I'm just telling you, sometimes that's the comment we've seen
Yeah.
from investment committees is, oh, what do you do with these? And, you know, maybe that's the cost when, you know.
But if
w-
they're paying what the cost is, it's hard to say,
Yeah.
well, you're not gonna have to pay it, but you're gonna be paying for it.
but
Yeah.
Congratulations,
telling him he
Mr.
has to pay
Shawcroft,
for
you're
the-
covering the fee for
Yeah.
those 5
We're all
people.
used to that with the current tax.
What else is new?
That's true. That's
Well,
kind of the way it's been.
You can see the argument that somebody who's retiring and maybe moving their funds into more secure things, they may be saying, well, I'm retiring and I'm paying a higher amount than all these folks who are out there risking money wherever.
Yeah.
Why should I be doing that when I'm retiring? I'm supposed to be in a more of a safe situation. But my basis points are higher
Yep.
because I'm moving to a more conservative portfolio.
Yeah, I mean, there's good valid arguments on both sides.
But isn't that partly mitigated if you're a through retirement plan versus a to retirement plan? In other
Well,
words,
if
you're
you're-
gonna be still in the market as a through retirement plan, in some of these where you're not just gonna go into safe money and
You choose not to go into a safe.
Right.
safe funds.
Technically, yes. I mean, if you're saying, hey, I'm going to, continue to be invested when I hit 65, then yes. But there's lots of variables there of, are you gonna stay in the plan, or at that point, do you roll it to an IRA where you can start to take distributions on a regular basis, those type of things. So, again, lots of variables there.
And just to clarify, Tyler, if I may, because I just want to make sure, because I'm not there, I can't kind of see everybody's facial expressions, but I just want to make sure everybody's clear that the asset-based participant fee really is only covering the cost of the plan, right? Because we're taking everything down to what we call zero rev share. So if somebody has a portfolio in the 401k plan that's highly aggressive, they could be paying upwards of 1% for, their particular portfolio, but everybody's paying the same amount to support the plan. So if it's 15 basis points, then everybody pays the same. So if somebody chooses to go into the guaranteed account and there's no revenue share there, they're taking less risk and they're taking probably less upside potential, but nobody's paying more than anyone else. You're all paying your own expenses once you get to zero revenue share. And I want everybody just to remember that
Yeah.
the only thing the asset-based participant fee goes for is our costs and whatever costs you want to cover from the plan. So I hope that makes sense.
Thank
We
you.
understand.
So in terms of follow-up, I mean, we can work to draft and work with any of those options. I don't know if there needs to be further discussion with the commissioners or from a committee as a whole. But I guess, how would you like us to kind of follow up on that?
Well, I guess I'd like to see a draft fee policy statement.
Okay,
It would be on a zero revenue share and a per account quarterly fee,
absolutely.
and an estimate of what those would be.
So we can send you a draft. What we'll do is we normally just take whichever option we choose and put it in there, but what we'll do is we'll just put all 3 to 4 options in there, and then we can take you through them.
Be fine.
Okay.
At least that's my thoughts, but
I was gonna say, I don't know, again, we're thinking about employees and how they're gonna react and what would seem most fair to them. I don't know if you two, with your
Well,
big
you
departments,
certainly-
have any perspective
You're
on
certainly
that?
gonna have to educate the employees, because.
Yeah, Lena, when
the-
we've
the
done this
appearance will
before,
be-
we usually do, we can do paycheck stuffers, we can do statements on the website. There's a regulatory notice that goes out prior to all these changes. And we can work with you to make sure that you and with Saltus to make sure you guys are comfortable with the language and what the participants are getting with the change.
Yeah.
Sure, but I think also we need to have meetings with the employees so that we can answer questions and just say, look, why is it being changed, if we change it?
Yep.
Why is it being changed? Make sure they understand, this will cost some more and some less, probably.
Do you have an opinion
why?
on the
And why?
asset-based versus per account? Do you think either one was
Because,
gonna?
you can correct me, but the zero base makes it sound like, whether somebody has $100,000 or $10,000 in the plan, the cost is the same for record keeping. Is that
Right.
correct? Yeah.
That's the per account
Yep.
fee would
Per
assume
account,
that.
per account.
But
Kinda
the
saying,
other way
yeah.
to do it is based on assets.
Right.
Yeah, it doesn't matter which investments you pick, you're all gonna pay the same.
Do you like per account better or?
Well, for transparency, maybe, but, for acceptance, when we've been with something for so long, it's gonna be, we've gotta make sure that
Resistance and, yeah.
that we help employees understand,
it'll take some explaining to them, but a lot of them don't understand how much they're paying now, and that's not right.
Well, that's right.
That's-
There's no way they understand that.
That's
I know
just,
That information really, I don't think has been available to an employee.
Well, and at the risk of being I'll refer to myself as a realist and maybe not so much as a cynic. It's either depressing or maybe exciting when big changes are made. It never ceases to amaze us at how the pushback is much less than you would think. You would think you'd have a lot of people looking very closely, but you'll find that you will have a few for sure, but it's usually a lot less than we typically see. And that just kind of speaks to that they don't know and understand it today, and they probably won't. But again, I think as you look at that, you look and say, hey, what's going to work best for the participants? What really is a way to make sure that everybody's paying their fair share, and at the same time, transparent has that cost. So we do see the zero rev share as kind of the cleanest way of doing it.
One question I have, Elena, maybe you can speak to this. We have temporary employees that are required to participate because it's their social security
Right.
contribution in a 457. Run us through maybe an example of what a per account fee might be on somebody that's just working part-time, and can we get creative in maybe helping to protect them? Because a lot of them are gonna complain, say, why do I wanna participate when the fee's eating up everything I put in?
Well, for starters, they have no option but to participate. It's
Right, that's-
required, but,
That's my concern as
but,
well.
and they have
Because I
no,
said so.
no ability to choose their investment either. They put 7.5% in, and it has to go in a, safe account and all that sort of thing. But I think that's a good point, and I don't know whether we want to lay a fee on top of that. I understand that, yeah, there's probably a cost to it, but, as it is, that's all we don't match it, that's all they have instead of Social Security.
Maybe
So-
the one comment I'd make is in a plan, you're not able to discriminate. So in other words, whatever you choose, if they're eligible,
We applied across
whether
the
they're
board.
part-time, full-time, you just want
Well,
to,
these are the sub-plan 457 ones we're
okay.
talking about, so I don't know if those could be separated or not,
Okay.
or if we'd even want to, but it's a good
yeah,
thing to think about, because, like I say, that's already a very bare bones
Yeah.
benefit, if you even wanna call it that. It's their own money.
yeah.
Well,
But,
none of us on this committee are obviously fall into that realm, but.
I have a
but
family
we-
member who does.
But we
so
have to
it's-
represent all of the
Right.
employees, so we really, and maybe there's a creative way we can do this, because, I'm hearing comments even from Prudential, this is a concern, when you have, small balances and the fee eats up their investment, there's gotta be a way, hopefully we can
Yeah.
accommodate that. but-
And their investment go into a zero or below zero? I mean, can they lose
Can't-
additional, can you have, do
Like,
they
can
have
they-
to take more money out of their paycheck? to
Can they
make
pull a
up?
negative? I don't know if Prudential can do that. I'll be impressed if they can.
I think the account's closed if it reaches zero, isn't it?
Yeah.
No, but that's where it can come. That's where it can get into some problems if you get really small account balances and people don't add to it, or if it's frozen, and all of a sudden we have charge it back to the plan. You get an invoice. It gets ugly.
Well, I'm thinking again of these 457 sub-plan 2 people, they work for a few months, a lot of them, and then they go away for several months and come back, so they're not contributing for several months in a row. I think that could create some issues there, and the other thing is we're required, to invest in something that will preserve the asset for them. Can't have any risk because it's in lieu of Social Security, so I'm not sure if there are any special regs about assessing fees to those accounts or not. We'd have to look, but,
And they roll those over to other accounts?
nope.
To another
Oh, you
similar
mean
account?
when they leave employment
yeah.
forever and for good, they can withdraw it? But many of those people are back and forth for
Seasonal.
years on end.
Fire guys.
Yeah,
Mosquito abatement.
right,
Fire
mosquito,
guys.
fire are two of the
Okay.
big areas where we get the same people year after year, but they're only here for a short part of the
Well,
year.
Does their money go into the guaranteed then? Is that where it goes right now, or is it,
Yeah. Right, Kelly, is that,
Well,
What's the-
I know your QDIA is Goalmaker, right?
Yes.
right, but
But
those
isn't
people
the
don't go
one
to
plan
Goldmaker, I
that
don't
that
think.
one plan that does go into the guaranteed?
Yeah,
The 457, is that right?
457 sub-plan 2, I believe, goes into the guaranteed.
Well, we can certainly send the draft of the fee
So,
policy
yeah,
statement. It will
let's
lay out
look at
kind of
it
the different methodology that you can look at and consider. And again, we've worked with Fred Reish, who we think is probably one of, if not the top ERISA, ERISA attorney in the country. And again, we know these are not ERISA government plans, but he helped us draft that. So it kind of lays out, these are the ways that you've kind of been told you can handle revenue share and how you do it and how you handle the fees. And we'll
Do we
go-
also get some scenarios, say, the employee A, we don't have to have names, but employee A that's identified as a seasonal person, fire, a mosquito bitten, this is what would happen to their account. Somebody who's been here 5 years, this is what would happen to their account. Somebody who's been here 10 years or more, this would be what would happen to their account. So we have an idea how it's affecting people at different levels.
Kelly, we could probably get some participant information
Yeah.
and mock up a few of those,
Yeah,
couldn't
just-
we?
It doesn't have to
Yeah,
have
we
a
can,
name
we can work with
attached
Cheryl
to
and
it.
get that done,
I was
sure,
gonna
not a
say.
problem.
We can work with Prudential to kind of help.
Yeah, clarify for me then, 457 is a separate plan from 401K, 401A. So on discrimination rules, you could have one set of rules for 457, a different set for 401K, and a different for 401A. I don't know if we want to go there, but
Technically, yes. What you would just have to do is say, if this is how we do the fee in the 457, everybody in the 457 pays it the same way.
right, and I'm okay with that, because to me, that's the real critical
So for example,
plan that
you,
we're talking about here.
and I don't want
They
to,
don't have a choice.
Kelly may shoot me for saying this because it's on Prudential's end, and Kelly, you can chime in if, but I mean, I guess technically you could say, yeah, on the 457, we're going to do an asset-based fee because those are small accounts, and those people that have really small balances, they're just going to pay a little bit of the fee because of that dynamic.
I want to say yes, we can. I do want to say that. I do want to check with pricing and then our
Yeah.
record keeping area. My guess is yes, because we record keep each plan separately. We
That
do
might be a
price
good
the plans
solution.
together, right? So we price them as one $150 million plan.
Possible.
We don't price them separately, so you're right. The fee on the 457 could be significant if you decide to go with a flat per participant or a flat fee. It could be significantly higher because of the assets and who participates versus, or even an asset-based fee. You could say that plan's going to have a 20 basis point fee and the 401k is going to have X. But then I'll have to work with pricing so we get back to what we need for record keeping. But it's probably doable.
So we can kind of wait from Kelly to help clarify there, because you could potentially look there.
Okay,
Guess we better keep moving,
Okay.
we're running out of time.
Yeah.
I know we've got 4:30 we have to stop. I'm assuming we'll plan to be done in 14 minutes.
Okay, well, good luck with that.
Let us jump into just maybe the quick review of the investment menu, and then we're happy to, I want to make sure we give Kelly some time on the report that she's got to go through. If you just go to page 35, tab under the investment review, and actually starting on page 32 and 33 and 34, gives you a breakdown of each plan, the assets, where the investments are, everything that's there. Page 35 actually takes the investment policy statement and it kind of puts it into a quick reference for you with respect to the criteria. And then page 36 kind of starts the reports that we have that we run on every single investment option in your plan. And you'll see on here we have a couple of recommendations today. One is, let me just start with the indexes. You've got a couple of Vanguard index funds in your plan. And as I think most of you know, an index is a really low-cost option. All it does is follow the market. For that particular part of the market, they have low fees, and you're going to get whatever the market gets minus the fee that you pay. We're recommending that you replace those from Fidelity. About a year ago, Fidelity, Vanguard's kind of been known for a long time as, the index provider. But this may surprise a lot of people. They tend to not be the most inexpensive. So about a year ago, Fidelity came in and basically put all their pricing right underneath Vanguard. So when it comes to an index fund, you want to make sure the methodology is sound, which it is on both of these firms. So they're basically doing the exact same thing. But at the end of the day, you're buying an index with an expense ratio, and you want to have the lowest cost that you can get. So Fidelity actually offers lower expense ratios in both of those spots, both on the Vanguard 500 and the small cap index that's there. So that's a couple of recommendations we'd make on changing out those funds, and then you'll see the Dreyfus Mid Cap Index is an expensive one. So this is something you see as well. Some fund companies have rolled out indexes, but they're pretty expensive. You look at Dreyfus; they charge 50 basis points for their index, and the Fidelity one is 5 basis points.
Is it less expensive than the Vanguard, comparable Vanguard also?
Yep. Yeah, Fidelity basically came out, and on all the major indexes, Fidelity's cheaper pretty much across the board. So, so those are the three recommendations around the index funds. As Brent mentioned, and again, for interest of time, we've got three funds that are on watch, the Janus Henderson Flexible Bond. If you look at that fund, it's done a good job. It's produced average excess return of nearly 1%. It's beat its benchmark about 95% of the time. The reason it's on watch there is one of the key managers departed this last year, and they have a team of 3 managers and a deep research analyst team. That team is still intact. It's been the only one, but that is a departure, and it is something that when something like that happens, they automatically go on watch status from our end, just because we want to dig in with that team. We actually have, spent some time looking at that. The team that's in place, we feel is a good, stable one, but one that we want to keep a close eye on. JP Morgan Mid Value and the Small Cap Value are both 2 really good managers. Both of those are managers that we think they've been a little out of favor here more recently in the last 12 to 18 months, but great stability in the teams long term. They've had good percentage numbers and have done a good job, and so we would recommend giving them a little bit of a leash and a little bit more patience with each of them in doing that. So that kind of gives you the recommendations in terms of changes to be made. And then you have the Clear Bridge, which we talked in our last meeting, and that one was approved from the previous advisor. It's kind of been in the queue. I know Cammie, before she left, was trying to kind of verify that the vote had been taken and done. I haven't seen anything
At the
confirming
commissioner,
that.
at the commissioner
Yeah, the
level.
My
commissioner level.
understanding is that it was never voted upon, is that true?
Couldn't find any other way.
It was
So-
voted on by the committee,
Right,
but it wasn't, we never got an approval from the commissioners. So about 2 weeks after the meeting, Cammie
Yep.
emailed me and asked me not to do the fund change.
Yeah,
So
she said
the fund change, everything's been pulled.
okay, so that one was based on being on a watch list previously or performance issues and so on, right?
Yep.
But it hasn't happened yet.
Yep, and we would concur with the recommendation given.
Okay.
Which 2 of those?
That's the Clear Bridge Small Cap Growth. And then the 3 index funds are, I guess, strictly on cost.
Yeah, and that's not large. I mean, you're going from 5 basis points. The Dreyfus one is large. You're going from 50 to 5.
Yeah.
But the other ones, you're going from 5 to 4.5 or 4.
So, and then the others are on watch. So, yeah, if someone wants to make a motion,
So I would move that we recommend to the board, the county commissioners, that the 3 funds as identified on page 36 for replacements be recommended to the board for replacement, in addition to the prior ones that were recommended, including the Vanguard 500 Index, the Dreyfus Mid Cap, the Vanguard Small Cap, and the Clear Bridge Small Cap.
Does that cover them? A motion to recommend the replacement of 3 index funds and, again, the Clear Bridge Small Cap Growth. The second.
I'll second, but I want a little bit further discussion. What's that average excess return number that's next to the symbol? What does that mean?
So what we do is we run a report. We actually built this report ourselves that looks at each of the managers, and what we're trying to do is it's called a consistency report, and we're looking at a rolling 5-year number for all these managers and looking at saying how consistent do they beat their benchmark. So the first number you see there that gives you the percentage, if I can get there with you.
Yeah.
Thank you. The first number there is the average excess return. So what that tells you is, hey, over the last 5 years, on a month after month, that manager has beat their benchmark on average by, so I'm looking at like JP Morgan Small Value. It's telling you by 0.88. So they've outpaced the benchmark net of their fees by 0.88%. And then the next number that says percent beating the benchmark tells you that 77% of the time, that's how frequent they're beating the benchmark.
So that number represents, in other words, the fund on the left, not the replacement that you're
Yes.
recommending?
Yes.
Okay.
Yes, correct.
I didn't like the negative number
Sorry.
next to the
Yeah.
replacement, but in all cases, the replacement would have good numbers to.
Well, the replacement, like when you replace with the index funds, they're always going to have a negative excess return because they're never going to beat the market. They're going to get whatever the market is minus the fee that they charge.
Okay.
So those where you see those negative numbers, they're also gonna be negative on Fidelity's end, but they're gonna be negative by less, cause Fidelity's
Okay.
just cheaper.
Okay, and then can we formalize the process of moving from this committee to the commissioners and how that process will take place? Because apparently it didn't happen last time, and
I think we just need to get a resolution on before the board.
who does
next
that?
meeting.
Is that something that the HR will
would
do?
probably do, or Mark, I guess, but, should we vote on this motion and second first, and then we'll talk
Yeah,
about
I've
that a little
seconded. I'm
more?
just
We've got a
gonna-
motion and a second to replace the three index funds and ClearBridge small cap growth. All in favor, say aye.
Aye.
Any opposed? Motion passes 4-0. And so, Mark, let's say you or I will get, an agenda item to adopt those recommendations, on the commission agenda, hopefully for next week, yeah? Did you want more process than that? or-
No, that's good. Just wanted to kind of formalize who was gonna do what, so it wouldn't fall through the cracks.
I don't know, we need to write up any sort of reason for the changes?
We've
or-
actually got those in the reports, so with each one of those changes, we give you a write-up as to,
Well, will the average excess return always be negative for the
for the index
guaranteed
funds.
fund?
Yeah, for the index funds.
For the guaranteed?
Yes.
The
Correct.
guaranteed fund.
Oh, for the guaranteed fund, not necessarily. No, there's a, again, with each of those, we're comparing them versus their peer group and whatnot.
So is that an indication that, at least right now, the guaranteed fund is underperforming against their peer group?
It is based on that report, yes. And that's something in terms of discussion on the Prudential side. And maybe Kelly, you can speak to that. Typically, the guaranteed fund and the platform is a requirement. But Kelly, maybe you can speak to that a little bit, of whether or not there's some flexibility as to some other funds that we can look at in that space.
I think there is, but I think last time, last time you had the wrong fund on there, so, our fund is not, we have other stable value funds, but the guaranteed income fund is, it's a flat fee that projects forward. So I remember last time on your book, and I'm sorry, Tyler, I don't have a copy of your book.
Yeah.
You had the wrong fund reflected in the stable value space.
Okay.
Did you correct that to the
We
guaranteed account? or
should
does it
have. I
still-
know from the last meeting, we weren't getting a feed from you guys, which we are now. So we get a feed from you guys basically every day that feeds into our reporting system. So I believe
you
that's been
just,
corrected, but I'll confirm.
Yeah, can you and send me over that book, and then I'll
Yeah.
take a look and see from a standpoint of where, I'll send it up to our investment guys and make sure that they're sending over the right information.
Yep.
Because generally our guaranteed account doesn't reflect poorly against other stable values.
Okay, yes, we would, we want to make sure that, like I said, that feed comes in. I know we have to kind of basically pull the QSIP number and then pull the plan, and it should feed in every day. So if you'll
Yeah,
confirm,
the
that would be
guaranteed
great,
account
Kelly.
doesn't have a QSIP, so that might be the problem.
Also,
Okay.
also, is there a problem with the Invesco growth and income R5? Because that's also negative. Yeah, large cap.
In the large cap space, Invesco growth and income. So it shows a negative return. It actually, when you compare it to its peer group, it actually meets the criteria. And
So its peer group was also very negative, it sounds like.
Yeah. And it's a growth in income, so there's, when you look at that Russell 1000 value benchmark, that portfolio is geared towards having some dividend payers, and not, the entire Russell 1000 does not. So there's a little bit of benchmark kind of tracking error that you get there with that manager. But when you look at them versus their, other managers that are managing growth and income names, that's been a pretty solid manager.
So Kelly, if we got these changes approved on the agenda, on the commission agenda on the 15th, would it be like a July 1 effective date, or what would your timeline be?
Yeah, we won't make July 1 now. You're talking about just the fund changes, right? And not the zero revenue share?
Right.
Right. Fund, we take about 80 days to do a fund change, so I would say we've got, what are we at the beginning of May? Sometime mid to late July.
Now, Kelly, can you do that with one letter, or do you have to send out 4 different letters?
We do it with one letter.
One letter?
We just, this fund's changing to this, and we categorize it all together.
So there'll be a charge just for one letter?
Right.
Okay.
Well, no, we don't charge for fund change letters.
Oh, don't
There
you?
won't be a charge for that. But when there's fund changes, we just go ahead and mail them. But it's one letter, probably like 9 pages though, because of all the disclosures. But we
Is-
take care of that for you.
Without
You
cost?
have to send 3 letters to people with accounts in all 3 plans.
That's right. We have to do that too.
Well, just killed some trees.
So Kelly, for clarification, there's no mailing cost then for that, for those notices?
Not for fund change letters, no.
Okay.
Other mailings there are, like the 404A and some of those. We do charge. You'll see those probably last year we charged for those because those are really plan level requirements, and we do it as a service to our clients, but not fund changes. When we are required by law to make the changes happen for you because we're holding the investment, so we need to send those fund change letters for you.
Okay, thank you.
Yep.
All right, where now?
So with that, I'll turn to the committee. Kelly, I know you have a report of 151 pages and it's 4:30.
Yeah, it's up to you guys. I mean, I'll be out there for the next meeting, and we could pour over this a little bit in more detail. I went through the report, and we can cover like 2 pages real quickly if you want, and then we can talk about it more in depth. I would think next time too we'd be looking at some of the different scenarios for the zero revenue share. We'll have some other things to discuss. So, really the pages that you'd want to look at is page 4, which is the combined. The combined assets in the plan as of 3/31. They've gone down a little bit, but we know we had a very volatile quarter, so that's not that surprising. And then you can also peek at pages 13. Really, that's that page that kind of breaks out, where the dollars are, how many participants we have, contributions in and out. I didn't see anything on either one of these 2 next pages that really showed any kind of difference. I mean, to me, it's very quarter over quarter. And then the next page we can look at, which is nice in situations like this when you run out of time, because it basically talks about everything we talk about at length. So we've got our plan feature. It talks about, GoalMaker and what's the assets in GoalMaker. We talk about income flex. So if you want to just briefly take a look at those couple of pages as well, that's really going to kind of show you from a 401k perspective, kind of the movement on the plan. And then the next meeting, I can go a little bit more into detail if you'd like, because I know you guys are on probably a hard stop, aren't you?
Well, we've still got a few things to cover, so that's probably okay.
I'm sorry, I didn't hear that.
You can take another 2 or 3 minutes if you want, but I think we can look at this
Okay.
after the fact too.
And I think just for the committee as well, as Prudential's good, they've got good reporting. They provide this to us along with other things that we also, we're looking closely at demographics in your plan and how the assets are flowing and how things are broken up in the different age groups and et cetera. That's part of what we do on the education side to try and as we formulate kind of a campaign there.
And Kelly, you did mention that you didn't see anything unusual from quarter to quarter that would need to be brought to our attention anyway, correct?
No, I didn't. I guess my biggest concern would have been maybe some fallout with what's going on with the payroll feeds. But it looks like from quarter to quarter, our active and terminated participants didn't have any kind of weird jump. So my thought is we're catching those as needed, and just working through them. So that's really where I kind of spent most of my time looking at. I know because Solstice is relatively new, we're working together with the HR team on communications and education, and I really don't have a whole lot to present there. So maybe if we can just get a little more time to talk about the plan next time, I think we're in good shape.
Okay, we'll plan on that.
But just to clarify, Kelly, you say you are receiving the employee donations or the employee inputs into these contributions into those
Yes,
plans.
as far as I know, they're all coming over now. And once in a great while, there could be some fallout on a feed, but I know that Carol and Brandon, and Lena's team are working through that. It isn't like back in October or November when we had some issues where speeds weren't coming at all. I don't believe that's the case because Carol has not even brought that up, that that's an issue. So there could be some one-offs where somebody falls off the file or some eligibility issues, but as far as I know, everything's coming in and feeding properly.
Thank you.
Kelly, this is Kim, I've got a question for you. Have you run into many problems with people going out and changing their contribution rates through you and then that information getting back to Workday correctly? I mean, I have a personal situation where it didn't work, but have you had any other issues that you're aware of?
I can ask Carol. She would know that, because if you're doing it through Workday and Workday's feeding it to us, or is it the other way around? Did you change it on the website, or do you change it in Workday?
Well, and that brings up an interesting point, because we've always been told here that you had to go out to Prudential's site in order to change your contribution rate, and then that would feed back into Workday. But when I talked to Brandon... that's the way I think is correct. Yeah, when I talked to Brandon, however, Workday was struggling, and I'm kind of in a special situation because of the catch-up provision. There's two different rates out there that show up on Prudential's side, but only one came over to Workday, and unfortunately it was the smaller percentage. So I don't know if you've run into that issue or not. I don't know if that's a Workday issue or how it's coming across. I haven't followed up with Brandon either on that, but does that make sense?
Yeah, it does. And so what we've been doing when we run into problems with catch-up versus regular deferrals is, and I can talk to Carol about this, that there is the option to just combine and not have a separate catch-up. And the reason I say that is because most people that use it know that they're going to max out of the regular deferral. And so our system just knows if you're over 50, you can go ahead and put more money in. I don't know if there's a reason why at the county you have them separated out. But sometimes that does correct the Workday situation because our system just automatically allows you to go to the higher amount, the 24. So you only have to change one. So let's say you want to take it out all the way across your pay periods and you want to contribute $24,000. You just have one contribution rate that gets you there. That's an option, but there might be a reason in your government why you have them broken out. Lena, do you remember if there is?
No, I don't.
The issues with the website, the website has the two different rates that it shows.
That's because the document, that's because the way it was set up when we brought you over, you allowed people to do two different deferral rates.
Oh, I think that's
you
confusing.
don't have to. All I'm saying is that could be a fix to Workday, and I'll have Carol and Brandon talk about it because it's a little too detailed for us. But and Lena, you might want to get in that conversation
we'll
too,
that.
just to
the
see if that makes sense to just streamline things.
It was a 401k because I was trying to max out the contribution, and to me it would be simpler just to have the one rate and not split it up. In fact, I think it's more confusing to Workday to have to deal with that split up as well.
And the catch-up is the year in which they turn 50. It doesn't have to be after the birthday, or does it? Well, we'll look into it. I can't remember. The year you turn 50.
Yeah, so it's the year you turn 50, right? Because as long as you turn 50 before the end of the year, you can put in 24,000. So
Just turned 50, Cal.
Happy birthday.
Yeah.
Everybody knows now.
And this is being streamed. Is that right? Cool.
All right, we'll have to look into that, but
I'm back in the 50 club.
that resolved, yeah.
Yeah, if we
yeah, I
could
wrote a
change
little
that to
note
one
too,
rate,
Lena.
that'd be my vote. Would make it
Now
more
we can
simple.
talk about that later.
Are there any other questions for me?
I think not at this time. We appreciate your book and your info.
Thank
Oh,
you.
you're very welcome. I will be attending the golf outing, and I guess Brandon is golfing in our team, and looking forward to seeing everybody out at the golf outing.
Great. Looking forward to seeing you too.
Great. Everybody have a nice night.
Thank you, Kelly.
Bye.
So we just have one last agenda item, and we want to be sensitive to time. I think we could cover it in 5 or 6 minutes.
Go for it.
Does that work? So I think with respect to, support for your employees and educating them, obviously that's one of the areas that we're looking and eager to engage. I'll have Jeffrey kind of just take through a number of things that we've got. We mentioned the education calendar. I think probably the biggest one is obviously being new on your plan. It's typically been our experience of being able to try and roll out kind of an initial campaign so employees know who we are and what we are able to do for them and how they can connect with us and those type of things. So we can talk through that. And I think we'll have Jeff take you through kind of the ongoing elements of education that are available to your employees as well, and then we can kind of finish the discussion there. Does that work, Jeff?
Yes, thank you, Tyler. So just to mention, so that you're all aware of stuff that we are doing ongoing, we do reach out to the employees every quarter with a document. It's called the quarterly flash report. We send out tidbits about education and 401k savings, just so that they are educated and know kind of what to be doing. With that, we also do online webinars every quarter, and we do try and coordinate those with different events that are going on during the season. So for example, we had one during tax season, so we discussed the difference between traditional and Roth 401k contributions, or so that individuals could understand those differences. So we are doing these every single quarter. On top of that, your participants are welcome to call in any time of the year to have a discussion with us. One thing that we would like to talk about is, and discuss with you, is how you would like to undertake some on-site visits. We do have the capability to do that even now. We've been working on getting that functionality ready, and we're ready to go at any time, but we want to put the question to you of how you'd like to see that done and when you'd like to see that started.
When you say on-site visits, are you talking about individual investment advice? as opposed to
Exactly.
education?
We can
Or-
do individual
yeah.
investment advice. We have the ability to do group meetings where we can have multiple people in the area at once. We can talk specifically to your plan, further introduce Soltis to the employees so they feel more comfortable with us. We have a whole slew of options that we can utilize.
And I don't know what you've talked about in the past as far as what we want, but are you talking about plan advice specifically, or whole life financial, looking at all
So-
assets and?
So we can deal into all of that. So our services include being able to sit down with an employee, help them look at their 401k account or their retirement accounts, but certainly if they want to have a conversation beyond that and actually take them to a planning level to help them look at and do retirement income planning, that's the type of capability we have to do.
And it's certainly common for us to do that as well.
And I think the expectation was that we've held to, or we're planning is try and basically be here once a month, where employees know we're here, they know who's coming. We'll have obviously Lindsay's on maternity leave; she'll kind of be leading our team in that effort, but have consistency in who's here, so they get to know who that person is, and then be able to sit down and undertake that type of conversation. I think the question is we're ready to do that. Is there a desire or a need to have us maybe come on site in a group setting to get introduced to people and who we are and what those services are, so that as we then begin to come each month, that they know what those are and what that is. And we want to be sensitive, of course, to your employees and time away from work and all of that.
And in my opinion, it might be nice to have an introductory one at the beginning to say, here's what will and won't happen at these meetings or whatever. I mean, in the past, they've done kind of a whole questionnaire ahead of time, so they've integrated a lot of information. And
Yep.
so I don't know if we're talking about the same kind of thing or something a little different, but I think it would be nice for employees to know what there is. And then we also actually scheduled appointments
Yep.
for people who wanted them. I don't know if you want to operate that way, or if you're thinking more, you'd just be here, whoever wanted to walk in.
We'd prefer to schedule is great, because it
Yeah.
gives us an idea of how many we need to have. I mean, if you've got a bunch, we need to have 2 advisors, or if it's,
I agree with that approach too. I think that's the way to
Okay,
go.
so maybe even before then, we could talk or sit down and
yeah,
really, so I understand what it is we're
okay.
talking about offering. And then we looked a little bit at, who was on this pathway calls, was that Jeff?
It was me and
Oh,
Lindsay and,
both. Okay, so,
yeah.
I think something like that we might wanna introduce also, just as more of a, this is a,
What is it?
Prudential has developed what they call Prudential Pathways Participant. It's a 6-part, I think, 4-part, I don't know.
Yeah, it's referred to as financial wellness, and it's
Yeah, it's
a
basically.
big part of what, when employees sit down and they want to talk one-on-one, a lot of it, maybe around their account, but a lot of their questions are, hey, I've got credit card debt, and what do I do? And
It's,
Is that
it's the
available
full
currently
financial,
on the Prudential
they're just
website?
rolling it out, so I think it will be on their website,
But it's not yet.
but they'll also do on-site classes. Dick's aware of it, and so they will, they like to get like a continuing group of, I don't know, however many, 20 to 25 participants, I think, that would meet all 4 sessions, and it's got some really good content. You can borrow the book and look at it, but it's not so much specific to our plans as just general personal financial wellness, and I think there's a lot of valuable stuff in here, so I think this could work in conjunction with what you're talking about, and,
You could
So I
introduce
would-
both.
yeah, I
These
would like
meetings.
to see us do both, and maybe that's a good idea. We just say, here's some new things we have
Yep.
available and see.
Well, part of that conversation, I think Prudential's got some good people that can do that. I think we're well equipped to be able to handle the one-on-one.
Right,
I think when
right.
they- if
So I
you
think
probably
that
gather
would
that,
make
Lane, I
sense
think-
to do it that way.
So we can work, and, you know, we've got other plans with Prudential that are utilizing it. We're actually utilizing it with a couple of non-Prudential plans, because it's a good program, so.
Okay, so, I don't know if
We-
we have to make a motion about this, but I think let's move ahead with both.
Yeah, I think for us, it's just a matter of how would you like to do it, and then getting it scheduled and coordinated, and we'll get, you know, we'll come with the content, so we don't want to put workload on you, it'll just simply be,
Good.
hey, what's the best way to do this, and we'll come, and we'll be ready to engage with your employees and kind of lay out what services we're able to offer them and help them with, and make sure they understand it's part of the services on the plan, that there's not additional fee for it, and
Right.
all those type of things. Okay. If you go down a page, the education tab on there, it'll show you some of these. For example, we have these quarterly webinars that any of your employees can tap into. July 18th is the next one. You can see it's on compound interest and just understanding how match and contributing your plan, and also understanding kind of, you know, investments in passive versus active funds, et cetera. So we do those on just a regular basis. They're happening all the time, and those are, you know, easies that we send out to you, where you can look and just say, hey, great, we send these out to our employees, and those that are able to join can join and participate. And they're not specific to Utah County. In other words, we have other clients that will join in as well and participate in those. But again, just good educational services that are available at the employee level. So
Do notices go out to all the plan participants?
we can.
Or maybe from
Which page are we
the
looking at?
HR and then it goes out?
Yeah, normally what we'll do is we'll have for example, if you look at page 98, that kind of gives you the flyer, and what we'll do is we'll send this to you, or we can work with Prudential to have them put it out on the website, and that's, but most of the time what we do is we'll work with Lena or somebody on your team and say, hey, look, this is available if you want to send it out to your employees to make them aware of it. That's usually the best, I think, way that it gets out and gets traction,
Where did you get
so.
Okay, so wait, these are webinars we're talking
Yep.
about here. And
Yep.
so it would be just like an email going out saying, tune in here if
Yep.
you want to see it.
And then,
Are
just
they
to-
available to go back and see now, or are they?
we do, we record them, so they can go and if they can do it at their own time and leisure.
Okay, do you want to send me some links or
Yeah.
whatever to?
Jeff, will you make a note of that? Let's make sure and send to Lena the links of the ones.
Is that how that quarterly flash report gets out too? That's sent to
That,
HR and they?
that one we
send
send to Prudential and ask them to put it out on the website, so when your participants log into their account, they'll get like a little notice that says, hey, you've got a quarterly note from Soltis, and they can go then click on it. So that one we work kind of just directly with Prudential to have them put it out there. Most of the
I
providers
just
really do
wonder
these.
how many people would see it out there on the website versus if there was a way
Yeah.
to email it to.
We can do, I mean, we're good to do either. We can send it to you if you prefer to email it.
Personally, I'd see it better if it was on an email versus out on Prudential's website. What do you guys think? Just quarterly flash reports. If it's just out on the website, how many people go out there often enough?
Well, I think a separate email would be better,
I do too.
just a reminder, even if it had just a link to their
Yeah, so what,
Right.
site or something.
Yeah, some reminder, because if we rely on them to go out to the website, I'm not sure how many people.
Yeah.
do
Some
that
of them are on
regularly.
there all day, every day.
Okay.
Almost, I would say.
Okay, we can do that. It's just sent to you, we'll just send it to you in like a PDF. That's how we put it out on the, and we'll still do both. Because when, like with most providers, they have the ability when somebody does log in, they'll get a message that says you have a notification or you need to go look at this. And that's where they'll kind of place it. So, but we can do both and you can send it out in a blast email. We're happy to have you get it out however you think it'll get traction, so. Okay, and then maybe the last item I'll just mention there is we, because I know we talked about this, is we have what's called retirement readiness session as well, and that's specifically for, you know, we see the need with most of our plans that have pretty sizable populations that are 50 and older. So Kim, you'd now qualify.
Hey, cool.
But these are sessions that we do, and we do these on a quarterly basis as well. And this is where we just try and help people that are about 5 to 10 years away from retirement, where we get in a room and just help educate them about the things they need to be thinking of and working on. And we'll typically have, you know, we can help talk to those participants about what things you need to be doing with respect to your investments or some other things as you get closer to retirement. But we'll typically have like a Medicaid specialist that comes and educates them on, this is when you're eligible and these are the things you need to be doing or be aware of as you get close to retirement. We'll have a Social Security expert that will come and, again, just educate them on what things they need to be aware of. And I know that's a little bit unique for you guys.
Just be sure they brush up on the
So we'll,
government pension offset and the
Yep.
windfall elimination provision.
so we'll do that, and then we'll typically have like an estate attorney that just talks about whether you've got a $10 million estate or a $10 estate. Some basic kind of estate planning and legal docs that you really ought to have in place.
You do those quarterly?
Yep, 3 to 4 times a year. We've done them quarterly.
Because the last one was in March.
Yep. So the summer's been the challenge. So I say 3 to 4 times. We've done them in the summer. There's been less, but we've been spring and fall. We've actually done a couple and then had to do a couple more with specific companies.
If the county feels like you've got enough participants that we could hold our own, we're happy to come and hold
Yeah.
just one for you here somewhere, just with your employees.
How's it compared to the state? State retirement does something very similar to this.
Yeah, I attended this one in March to see if it was good. I thought you did a good job, good information, and it's quite similar to what the
Quite
state.
similar to what the
does.
state
The
does.
state ones is longer, they might
Yeah.
go into a little more depth, but.
Hopefully
I thought it
Dave
was
can
good.
speak to it. We are adamant with the professionals we invite. We tell them you're not here to sell anything. You're here to help educate and just help these people understand what they need to be thinking about. So we're very careful to make sure that they don't, you know, they're not coming to a
Sales
steak
presentation.
dinner that's a sales presentation.
Yeah, but you have to be present to get the refreshments, it says.
Yes.
You do have to come to get the refreshments.
And we do
Can't send 'em.
it via webinar, but we won't mail out the
Your
refreshments.
okay.
As good as Amazon's getting, we're just not gonna
I was
do
gonna
that.
say, we could get a drone, couldn't we?
Okay, that's all we have on our agenda. We appreciate the time. We know we've gone long and lots of good discussion. Let me just go through kind of follow-up items, and Jeffrey, I know you've been capturing these, and the motion was made on the investment policy statement for us to make the final corrections that were sent over this morning. We'll do that and send you a final document, and then that will go to commissioners for approval. We'll send a draft of the fee policy statement. We discussed through the fund changes, on that fee policy statement, we'll lay out for you the various options, as well as try and work with Prudential to give you some case studies for different employees at different stages. And then on the fund changes we went through, and we've got a note there as far as to be ratified again by the commissioners. And then we're going to work with Kelly just to make sure that the guaranteed income option that we've got in the reporting is the accurate one. And then we will send the quarterly flash report out to you so that you can disperse that along with the webinars in an email, as well as putting it out, working with Prudential to get it out on their site. Is there anything that I'm missing, Jeff? Okay.
Is there any fiduciary training you need to provide to us real quickly? Or is that?
The fiduciary rule has taken, it continues to just morph. actually, Kim and I will be in Washington DC on July 24th and 25th as part of the Government Affairs Committee.
That's the other Kim, by the way.
Yeah, the other
Not
Kim.
me.
Kim, who's our president and CEO. So he and I will both be in DC because they've made some here. Just and again, we fully recognize that you guys aren't held to ERISA statute, but there's a couple of things that are interesting. This last month, they continue to try and push advisors to the fiduciary level, for example, that we take on. They're actually, the latest round of that is they are going to require anybody that works in a brokerage or doesn't take fiduciary status will no longer be allowed to refer to themselves as an advisor. They will have to refer to themselves as a broker. So if they don't take fiduciary status on the plan, they can't say I'm an advisor on the plan. They have to say I'm a broker. And they're trying to make people, help that line be clearer for participants. And then at the same time, a couple of the large lobby arms from FINRA have pushed really hard against the DOL on trying to hold everybody to that fiduciary standard. And actually, one of the circuit courts struck down the DOL, so that's kind of the first loss that they've had. So it continues to develop. It's been kind of amazing from our standpoint. You guys know it all too well, that you have companies that are working and spending millions of dollars on putting policies in place and that just continue to change about every other month. So, but we're, again, our role in the Government Affairs Committee for the National Association of Plan Advisors is we go back to DC and actually sit with the Finance Committee and try and help explain and educate them so that the laws that they roll out as they make these are better laws. And we'll be involved heavily there, so, as we have been.
Hi, thank you.
Okay.
So next we have on the agenda to approve and set time, date, and location. I guess, is that where we're gonna discuss the rest of this stuff, is the idea?
Well, we would have this and then we would come back and see if there was, see what else we did.
Anything more? Okay. So,
So I would move that we set a closed meeting for today's date at this time at this location to discuss the character, professional comments, or physical or mental health of an individuals.
okay, motion, is there a second?
Second.
Motion and a second, to set date, time, and location for closed meeting to discuss character, professional competence, or physical or mental health of an individuals at this location right now. All in favor, say aye.
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 Any opposed? 4-0, meeting is set. That before. So, is that just for the committee then?
For the committee and